Three quality stocks to buy near their 52-week low. This is a series that I do every Saturday, and I talk about stocks like Fico, Berkshire Hathaway, and other stocks trading near their 52-week low, and I give you my opinion on them. And many of you guys have enjoyed those videos, and I told you guys 2 weeks ago that Fico stock was overvalued. Some of you got upset, but it's been true so far because the company has reported amazing earnings and the stock is going down just because it was extremely overvalued. It was priced to perfection. But now Fico is looking better. So I'm going to talk about Fico again. And I'm going to talk about two highly requested stocks, especially the last one, because it's a stock that I used to own and I'm thinking of buying the stock again, potentially. So I'm going to talk about all these things. And if you do enjoy them, if you like them, all I'm asking is please press the like button and let me know what you think in the comments. But this is something that I do every weekend where I go on any screener, any free screener. You can go on Fiscal.AI and use my links. They give you free access if you want. But you can just look at stocks within their 52-week low, and you would be surprised what you would find. I mean, stocks like ISRG, Intuitive Surgical, it's at 52-week low. You know, stocks like Sherwin-Williams, this is one of the best business models ever, is at 52-week low. Stocks like Copart, that doesn't happen very often. Chipotle is at 52-week low. So you could find a lot of ideas, and it's something that I always do. But for Fico, it's down 30% year to date, 30% for an amazing quality company like Fico. It's been crazy. Now for their report, revenues have been steadily increasing quarter on quarter, amazing stuff. Booking has been increasing quarter on quarter. Earnings per share, amazing earnings per share growth, amazing EBITDA. Again, the company has reported the perfect report. Everything you could want, they pretty much did it. The core business is still massively increasing. And in terms of the professional services, which is mainly their software business, little to no growth, and it's been holding steady. But the core business has a long way to go, as it's still a tiny fraction of the overall cost in terms of buying a house. And I don't believe introducing the Vantage score is going to affect a lot of the mortgage companies that have been using Fico for decades. They're not going to stop using Fico scores just because it's $2 or $3 more expensive. This is not going to happen anytime soon. So this business has very long runways, and I'm extremely interested. I'm getting very interested in the company. Guidance, insane, massive, just mind-blowing. Earnings per share, they raised it again. Now it's 29.15. It was 28.58. So it's the company has been firing on all cylinders, but the stock is going down. Why? Because it was just priced to perfection. The stock was trading at 80 times earnings, guys. 80 times earnings. That was extremely expensive. Now it's trading at 42 times earnings, with the average multiple being at 37 times earnings. And this is something that's very important to know. And it was just too expensive. Now it's starting to look much better. Now for my own estimates, the way I'm valuing Fico is I'm looking at their earnings per share growth estimates. They estimate 21% for 2026 and 24% for 2027. So 20% growth for many years to come. I don't personally believe this is going to be sustainable forever, but it's likely going to be sustainable for the next few years because of what I told you guys in terms of the Fico score or checking credit score being such a low percentage of the total home buying process. It's immaterial. It's not even funny. So the company can still raise prices and they can still grow with the market in general. So I still believe 20% growth is likely possible. So all I did here is I put in the current earnings per share of 2025. Then I use the analyst estimates for the next 2 years. So 21% earnings per share growth, then 24% earnings per share growth. And after that, I put in 20%, 20%, 20%. Now, maybe this is too optimistic, but I'm just showing you like the best case scenario. The PE right now is 42 PE. I put in a PE of 30 times earnings. Now, 30 times earnings might seem conservative because the average is at 37. But I personally believe with Fico, it's not going to grow 20% forever. So if by 2030 the growth is at 10%, 12%, 15%, the PE will likely be lower than what I showed you in terms of a historical average. So there is a very good chance that the PE could potentially go down to 30 times earnings. Now, if that happens, and that, in my opinion, 30 PE would be pretty much the worst case scenario on a company like Fico, you would have to buy the stock at $1,147 or around a 17% decline from today's price to get a double or a 15% return over the next 5 years. But this is just using 30 PE. If we use 35 PE, which is a little bit more reasonable for a quality company like Fico, if you use 35 PE, then if you buy the stock right now, you can potentially get 14%. But for me personally, I would be more comfortable using 30 PE for my estimate, which would get me 1,147. And for me personally, anything close to 1,100, so 1,200, 1,250 would start to look extremely interesting for Fico. So the best I can say for Fico is if you're dying to buy the stock, I think it's getting much, much more interesting than it was when I made my last video. Much more interesting. They raised guidance. The company is doing so well, and they will likely do even better. But if you're more conservative like myself and you don't want to overpay, I would say anything close to 1,100 would be a generational buying opportunity on a company like Fico. Now, the second one, which is also an amazing company, and it's a well-known stock on YouTube. Many popular YouTubers, I believe, they used to own the stock. And you never imagined Chipotle would go down 30% in a year. It's down 29%. The stock has been an absolute disaster. But the performance of the company has really tanked. Revenue growth was only 3%. 3% revenue growth for Chipotle. Comp sales, they decreased 4%. This is absolutely insane. They raised prices too much. I try to go there and I see that. They raise prices a little bit and people are just noticing the difference. Operating margin, 18.2 versus 19.7, terrible. Restaurant level operating margin, 27 versus 28.9, also terrible. Earnings per share was 33 cents or a 2.9% decrease. Where's the growth? Where's Chipotle? This is not Chipotle that we all know. I don't know what happened to this company. Since the CEO left that company, it's been downhill. If you look at comp sales, from 11% to 6%, 5%, negative 0.4, negative 4% for Chipotle. This is unheard of, unheard of. You would have never imagined Chipotle declining 4%. But they made a lot of mistakes. They raised prices too much. I think they overestimated the level of their price increases that they put up, especially now. They have more competition from companies like Kava and other companies that are kind of doing the same business model as Chipotle. So they're suffering. And it's terrible, but it's still an amazing company. And they went through many challenges before, and they always came out of it. And this time could also potentially be the same. The company's multiple did contract. It's trading at 32.5 times forward earnings. It was trading as high as 60 times earnings for a restaurant, fast food place. Insane. Now it's trading at 32 times, which is starting to get a little bit more reasonable for Chipotle. We look at their earnings per share growth. The analysts, they're expecting a massive rebound from 7.4% to 17. So they're expecting a pretty big rebound with Chipotle. Now, all I did here for my estimates, again, is I took the $1.20 of earnings per share, which is for this year of 2025. Then I use 17% for the next 5 years, which could be optimistic, but I'm trying to make a point. Now, if earnings per share grows 17% for the next 5 years, we get $2.63 in earnings per share. Now, I did show you that the PE is trading at 32 times, but as I believe the company is maturing a little bit more and the growth is slowing down, and even 17% is too optimistic, I would not be comfortable using 32 PE. I think 25 PE would be more appropriate for a company like Chipotle, especially 5 years from now. Now, if I take this number that we got, which is $2.63, and we take 263 and we time it by 25 times earnings, we're getting $65.75 per share. The stock right now is trading around $42. But if I want to double my money over the next 5 years with 25 times earnings, I would have to buy Chipotle at around $33. So for me, Chipotle is good. It's not too bad at this price. But if I'm, for my own taste, I like getting at least doubles over the next 5 years on the base to worst case scenario. And if I want to do that with Chipotle, I want to buy the stock at $32. I don't know if it's going there, but I don't really care if it goes there or if it doesn't go there. There's so many amazing opportunities in this market. I don't feel the need to FOMO in Chipotle. If it gets to $32, $35, at least $35, then I would say yes, it would get interesting. But right now, I say I would buy Fico before I would buy Chipotle. There's way better opportunities in this market. And I think anywhere close to 35, 34, 33 would be very interesting on Chipotle. Now, the third one, which is a stock that I used to own, and I sold it, I believe, in late 2023, and I'm thinking of getting back in. It's getting very close to my original buy price. And this is Otis Worldwide, which is an elevator company. It's one of the best business models you could own in your lifetime. And the company has two main business segments. The first segment, which I should talk about first actually, is a new equipment segment where they pretty much install elevators. You want to build a building? Otis is one of the most popular elevator operators and elevator installers in the world, worldwide, in China, United States, Europe. It's a worldwide company, very well known. I'm sure you've gone through many elevators. If you read the logo, it could say Otis many times. I'm sure you've seen it if you pay attention. So they're very well known. This segment has been declining, but I'm going to talk about it. The operating margin on the installation segment is only 5.3%. Now, the beautiful part about the business of Otis is once they install the elevator in a building, they get long-term contracts, sometimes 10 to 20-year contracts to maintain the elevators. The money is always in the maintenance. It's not in selling those elevators. It's the same thing with the dealerships. The dealerships, they don't make their money selling you cars. They make their money maintaining those cars, fixing them, maintenance. This is where the high margins are, and this is where the stability of the revenue comes in. And if you look at their services revenue, it has 25% operating margin, massive, massive margin, and it's been growing very, very well. So once they put the elevator, yeah, they can hire another company, I believe, but most people, they just stick with Otis because Otis installed it. Otis knows everything around it. There's some special parts that you have to go through Otis or whatever, and they pretty much have a monopoly in this space. So most people, they just stick with Otis, and Otis charges high prices because very few people can have the skill set to meet or compete with them, and it's just an amazing, amazing business model. Now, the main problem with Otis is China. They have a very large China exposure, and China is killing the growth. So if you look at their backlog or orders, it was only 4%, okay? Or for orders, 4%. But if you exclude China, it was 14%. So the business is booming, is rapidly growing, but China's slowing real estate market has been pretty much killing the company. And it's really, really bad. So much that they had to lower the outlook of down 1 to 4% to like negative 7% on new equipment. And the whole business is getting killed mainly because of the downturn in China. Now, the good news is that China, as a percentage of revenue, has been decreasing over time. So in the beginning, it used to be 2.5 billion in 2022, then it decreased to 2.4, then it decreased to 1.9, and now I believe it's like 1.6 or 1.5. So you could say Otis is kind of experiencing the same thing ASML is kind of experiencing with China with their semiconductor chips. It's the same thing with Otis elevators, but over the long term, China will become a less of a percentage of revenue. United States and Europe and other locations will grow, and the business will flourish. You can't really destroy the business model. It's bulletproof, one of the best business models in the world. Now, the company is planning some kind of a China restructuring, and they want to restructure the business in China. I don't know if they're going to sell it or what they're going to do. I hope they would sell it. The stock would skyrocket. But the main problem is China. But if you're a long-term investor, that's going to be a smaller problem over time. Now, if we look at the multiple of Otis, it's now trading at 20 times earnings. This is very interesting. The average is 24. It traded as high as 26, 27. And anytime Otis gets close to 20 times, this is when I bought it actually. It was 20 times in 2023. And I sold it for like 15% gain in 2 months or something crazy. But 20 times earnings is generally a good buy on Otis. So you would be paying 20 times earnings for one of the best business models in the world, recession resistant, dollar resistant, Federal Reserve resistant, president resistant, whatever you want. This company will do well no matter what, especially in terms of sales. But you're also getting decent earnings per share growth, 5.7% this year, expected to pick back up to 10%. So double digits earnings per share growth. You're paying 20 times earnings. You have the potential for a multiple expansion back to 24, 25 with a company that's relatively safe. In my opinion, this is a good value proposition. So I like Otis setup over here. Chipotle, not too much. It's really the worst one out of the three. Fico for Isaac is looking very, very interesting. But if it gets close to 1100, I'm all in 100%. And if you're interested in what I do and what I buy and what I sell, I share everything I do in my own group. This is the link if you're interested. But thank you very much for watching. Not financial advice. Hope you enjoyed it. If you enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.